Good afternoon, everyone. You may have noticed that the temperature is above 0 degrees Celsius today. I wanted to just wear a t-shirt. It felt so warm. But I didn't. I'm David Howell. I teach in the history department and also the East Asian Languages and Civilizations department. And this year I have the pleasure of serving as the acting director of the program in U.S. Relations. And in that capacity, I'm delighted to introduce our speaker and the seminar today. I should say, I want you to my introduction. The seminar is co-sponsored by the Harvard Korea Institute and the Losavar Ramani Center for Business and Government at the Harvard Kennedy School. So we thank them for their support. Professor Bill Grimes is a professor of international relations and political science at the Frederick Pardee School of Global Studies at Boston University. He previously served as the Pardee School's Associate Dean for Academic Affairs and as the founding director of the BU Center for the Study of Asia. Bill has published extensively on East Asia's regional financial architecture, Japanese political economy, and South Korea's financial statecraft. And he has a PhD from Princeton University, which brings him into a nice club of Princetonians here at Harvard. Sorry, swell with pride. Grimes is the author of 2 books, Currency and Contest in East Asia, Cornell University Press 2009, which was awarded the 2010 Masayoshi Ohira Prize for Outstanding Book on the Pacific Basin, and received an honorable mention in the competition for the Asia Society's Bernard Schwartz Book Award. And he's also the author of Unmaking the Japanese Miracle, Macroeconomic Politics, 1985-2000, also Cornell University Press, 2001. He's co-editor of Japan's Managed Globalization, Adapting to the 21st Century, Sharp 2002, with Ulrike Schede. His recent articles, co-authored with Ye-Chan Lee and William Kreng, are The Varieties of Financial Statecraft and Middle Powers, Assessing South Korea's Strategic Investment in Regional Financial Cooperation in Pacific Review in 2024, and then previous to that, Financial Cooperation in the Asia Pacific as a Regime Complex, Explaining Patterns of Coverage, Membership, and Rules in Review of International Economy, 2023. Bill is a longtime friend of Harvard and the U.S.-Japan program. He was a postdoctoral fellow here in 1995 and 96, and was a Reischauer Institute visiting assistant professor of government in 1999 to 2000. And he frequently serves as a discussant for program associates panels, including an upcoming one in April. His talk today is titled Patient Social Capital. So social capital that's also patient, I guess. Patient, social capital, explaining the rapid growth of the social bond market in Japan and South Korea. And so please welcome me and welcome Bill Grimes.
So thank you. I'll give you a little bit of a background to this, which is that this is a paper that's in progress with my student Ye-Chan Lee, who unfortunately is a Beppu, so he can't be here. He's currently at Ritsumeikan Asia Pacific University, and next month is going to move to Hanyang University in Seoul, Korea. So neither of those fits with being here today. So I'm doing this alone. Second, I just want to say thank you for the kind invitation and introduction. I have deep affection for this place. I was in the Bowie Vernon room many times before this particular room existed. Susan Farr was the director of the U.S.-Japan program when I came here, but she wasn't here. It took me a year to meet her. Steve Elliott was an office mate during that time, and Shen I've known since he was a child. Actually, he was a gaki, right? He was 22 years old or something like that when he showed up in grad school. So I have many memories in the room as well as new acquaintances and friends. So what I'm going to be talking about today is something that people may not be super familiar with, which is the social bond market. So let's talk a little about social bonds. I think, well, there's a broader picture of socially responsible finance, which is usually referred to as ESG finance. And the E stands for environmental, S stands for social, G stands for governance. Most of you are probably aware of various forms of environmental bonds, green bonds or sustainability bonds. And that's like the big brother of this, of the ESG financial sector. Governance is honestly, like, we don't even care almost. It's tiny. It's kind of a weird little niche, and social is something that is becoming more popular among certain types of institutions and certain types of investors. It's still a relatively small market, but I think that it gives a really interesting lens into the way in which government institutions, quasi-governmental institutions like the Development Bank of Japan, and markets interact in order to create what is essentially a new kind of bond market in everywhere, right? So when I say new, it was first defined in 2017 by the IFC, the International Finance Corporation of the World Bank. The standard one that we all use is something called the International Capital Markets Association. The revised principles are 2023, but they first created the principles in 2018. As far as I can tell, there's not a huge difference between the old and the new, but regardless, this is a recent phenomenon, and so necessarily things are a little speculative. But on the other hand, we're seeing the development of the market in time. So here's the broad definition. I'll read it. Sorry. Social bonds are any type of bond instrument where the proceeds or an equivalent amount will be exclusively applied to finance or refinance, in part or in full, new and or existing eligible social projects which are aligned with the four core components of the SBP. And basically that means that they have to be used for social benefit of some sort. Now, what social benefit is going to vary quite a bit. I'll just give you a little hint right now, because we're not going to go into the guts of this thing very much. But the largest social bond issue that's been done to date is for public housing in France. If you look at the Japanese ones, a number of them have to do with quasi-governmentals, but there are some companies that issue them. In the Korean case, a number of these are companies that are doing things like building dorms for their employees, which may not sound like social purpose, except when you look at the Seoul housing market, kind of like anything you can do to build more housing is probably a good thing. And in the Japanese case, this has even been stretched towards drug development. So right now we're still in a place where it's kind of a little bit amorphous, but for the most part, it has to do with things that are public amenities. And again, housing. In the Japanese case, highways, rail, these are the biggest issuers. Okay. So, as I said before, there's most of the attention to date has been on environmental, on green bonds, on sustainability bonds. Social bonds are a little bit more niche and less well known, and they're relatively new. So one of the interesting things, though, is that this is one of the types of financial innovation where Japan and Korea are I'm not sure necessarily leader, but they're toward the front. Okay, so it was first, I think it was most enthusiastically introduced in Europe. But if you look at the number of issuers, Korea's number one and Japan's number two. You look at amount. If you look at amount, you'll see the France is the biggest, USA is second, and then Korea and Japan. So they are leaders in this area, and that's not something we can say about very many other financial innovations, right? It's not something you can say about like AI chat box advising. It's not something you can say about derivatives, when they were first introduced in the 1980s. It's not something you can say about a whole variety of things. And yet, in this space, they are, which is interesting, right? In general, when we talk about Japanese and Korean finance, and more so Korean, because Korea got a later start on financial liberalization and development, is that they tend not to be at the forefront. And a lot of the time we identify the reason for this as legacies of developmental state financial system. It's a big mouthful, and I have a very clear idea of what I mean by it, and I could go through each piece of it, but not. I'm just going to give a little flavor of what I mean, of what I think I mean, and what I'd like you to take away from. So, and we'll get to that in just a second. Actually, I'll have that on the next slide after this. But one of the things I'm more familiar with the Japanese case, and my co-author Ye-chan Lee is clearly more familiar with the Korean case. But we have a couple of trends that we can identify in terms of financial liberalization in Japan and the United States. So the big movement towards trying to create Tokyo as an international financial center, or as a place where as an international financial center, dates back to the 1980s. With the creation of the first international financial or offshore market, which is confusing. It's not really offshore. It's not really a market. It's onshore, but it's subject to different rules. And going back to the mid-1980s, there was this effort that was also attached to a thing that I studied earlier, which is called internationalization in the end, but trying to develop the Japan as a vibrant and advanced financial center, and today we're still doing it with Fin City Tokyo, and the people who are involved in this are very, very, very good. They're very smart. They're like excellent economists, very fine businessmen and bureaucrats. Sorry, I say businessmen, but it is businessmen. Sorry. We can discuss this later. Actually, we probably don't need to discuss this later. So it's not for lack of effort, but it has been difficult to do. Initially, because of the long legacies of regulation, the bank-based financial system, considerable regulation in financial markets, and then over time, a lot of those things have been taken off. So the Big Bang in 1997, which was implemented 1998 to 2001, eliminates a lot of those things and makes the regulation of Japanese financial markets roughly similar to the regulation of New York, London, Hong Kong. Not identical, right, but roughly similar. And yet still, we don't see a high level of internationalization of the type that people have really hoped for. But this, to some extent, this appears to be that there are a lot of different components of what makes financial markets liberalized and attractive. And each time you sort of knock away one, you realize there's another. So you knock away the financial rules and you come up with tax issues, right? You knock away the tax issues. Actually, you didn't knock away the tax issues because there's more tax issues. And tax, for those of you who are familiar with the Ministry of Finance, the Tax Bureau is famous for its unwillingness to change its opinion for anybody else's reasons or not. And it's generally known. Do we have any Ministry of Finance people? Okay, okay. That's sad because I wanted her to be able to raise her hand and verify that I was right. The nickname for the Tax Bureau is North Korea. And yeah, but Japan is as a market has now really shifted in terms of almost all of the parameters that we would think are important, except that they don't operate in English, not surprisingly, and personal tax is still pretty high. Turns out that finance pros don't like to be taxed. and that may have some effect. But basically, it's the same place. But when you look at the way in which most financial innovations have filtered through the system, Japan is still not the place for where innovation has been sort of at the leading edge. They're followers, but they're not. This is not the place to find radical transformation. And Korea is really a story of financial innovation under duress. So there was there's a little bit more to the story than that, but the 1997 crisis was really key to the development of Korean bond markets in particular, and asset-backed securities markets of various sorts, as a way of managing a problem of financial crisis. Again, there's more to it than that, but I will stop. Won't go too far. Okay, if we look at issuers, going back to social bonds, if we go back to issuers, what you see is a lot of Koreans, some Japanese, and a smattering of Europeans. Okay. So again, this really makes the point. And the other thing to note is that a lot of these are official institutions. Okay, so Korean SME and Startup Agency. That's actually an agency of the government. It's not what we would call a quasi-governmental or government corporation. You have the Asian Development Bank, obviously Multilateral Development Bank, International Finance Corporation. In Japan, you have East Nippon Expressway, does a lot of these things. In France, this is the Caisse d'Amortissement, so it's the. I won't test my French on this one, but basically it's a government financial institution. Okay, so the puzzle is, why have Korea and Japan been so quick to develop social bond markets? Because we often see developmental institutions as a hindrance in financial innovation, and there's a variety of factors that typically that are put in this. So that dependence on bank funding, right, which is a standard part of most countries' economic development, but Japan maintained a higher level of bank dependence or bank role in finance than other countries at their stage of development. United States, UK are always kind of at the far end, and Europe is in the middle. But Japan's generally been a bit of a laggard in this. You may or may not think this is a good thing. I'm just stating it as a generalized fact. You have a long tradition of business-government relations, of close business-government relations, not always one way, not always fully consensual, but always there. You have the traditions of, particularly in Japan, the keiretsu, where you have your main bank is often connected to other companies in your network. Right? There's a whole variety. If you go to a finance conference, and for better or for worse, I spend a fair amount of time at these, you'll hear about people talking about Japan's a saver mentality rather than having a risk culture. So some of us may think risk culture sounds a little dangerous, but I assure you that the finance bros disagree with you. They think the point being that the willingness to take risk and to therefore to pursue return, higher return, rather than bank lending, which the best you get is the interest rate you have. So that would be a much more stable economic system. And so those are all these things that I think we're pretty much aware of. Korea and Japan are rather different in the relationship of banks to the chaebol, in the relationship of banks to the government. But the developmentalist story is not a bad one for both of them. So our story is that this is one of the financial areas in which those existing developmentalist institutions don't retard financial innovation, that they become, that they're essential to the development of this thing. And we'll see the story here. Unfortunately, the statistics on the demand side on who buys these things are rather bad, or at least the ones that are publicly available are rather bad. I'm sure that somebody has better stats than we do. We just haven't found them yet. And I probably need to go begging. But we see government actors operating on both the supply and the demand sides. We see in the case of Japan, it partly reflects partial privatization. And you can tell me if I'm being a little unfair about calling DBJ and other things partial privatization, and the role of quasi-governmental actors. And then this last notion is this probably makes no sense unless you've been reading in the international political economy literature. But financialization is this notion of shifting more and more public goods, more and more classic governmental responsibilities to the private sector. So the classic part of that would be spinning something off to a quasi-governmental agency and then funding that with bond finance, where they're kind of responsible for making their own money. Okay. To me, this story of financialization, I personally hate the word. It's just the word that's used. And so we're trying to get published, so we will use the word. But it reminds me of the long-term development of the Japanese and Korean developmental states. In that, going back, okay, now I'm stepping into history and I'm not good at it. If you go back to the Meiji period, and if you look at various key episodes through since then, through at least through the 30s or so. One of the themes is that Japan is that the government is very involved in the economy, but has a very small footprint. It's very low levels of ownership. And there are these examples, and I will run out of examples very quickly, like the Tachio copper mines. The government is first very involved in financing it, and then they run out of money and they have to sell it off. Essentially, it's an outsourcing of public purpose. And that's something that we see in Japan. We see something we see in Korea. And in the last 20 years or so, 25 years, what's driving this is fiscal restraints. It's restraints on the ability to collect more, to extract more taxes, more government-owned money then from the economy, whether it's political constraints or economic constraints like the Asian financial crisis was for Korea. Okay. So if we're thinking about how do you create a new financial market? How do you expand this thing? And there's basically three pieces. You can think about the system, you can think about the supply side, you can think about the demand side. And my apologies, I think I keep stepping into this. But everything kind of orients to the right here. So you should be able to see everything I've got here. So on the regulation side, and now I'm going to focus a little more on Japan, is Japanese, Koreans too, have adopted the ICMA social bond principles as the definition of what a social bond is. It's surprisingly important to define things clearly for financial actors because they have to then report them in some way or account for them. With regard to ESG bonds of various sorts, and especially environmental, but also to some extent social, there are places that regulate or that mandate that financial institutions, banks, et cetera, have a certain amount of green or ESG compliant finance in their portfolio. Right? And there are some of the central banks also kind of have an internal mandate that they're going to do a certain amount of green or social finance. So being on one side or the other of the line between social bond and not a social bond ends up being important. And so the definition is important. Japan they both adopted these, and they adopted them very quickly. So the first Japanese social bonds came out within a month or so of the ICMA bond principles coming out. You have to have good quality market regulation. Japan certainly does. Japan has excellent market regulation. It has the current law governing financial markets is the Financial Instruments and Exchanges Law. And FSA, the Japanese Financial Services Agency, is a highly professional, highly capable, well-funded place. Okay, so you got that. On the supply side, okay, so that means who issues bond? Supply side, so largely it's government agencies, quasi-governmentals, and international organizations. On the corporate side, a lot of it is housing, roughly speaking, what you might call corporate social responsibility. So if a lot of companies feel a mandate from society or an expectation from society to contribute to the community, in business school talk, this is corporate social responsibility, or CSR, and you can fund that. You can use that as an explanation for social harm. And on the demand side, the big thing that's driving it is that there's rising demand for ESG bonds. Less so for social than for environmental, but there are a lot of investors, whether household investors or funds, that want to advertise themselves as socially responsible. Many of you may have either purchased them, depending on how much spare cash you have, or had them marketed to you and not purchased them. But there's certainly growing demand for ESG bonds for the reasons that I gave. So I hit all of them except this last one, which is pump priming in Asia. And so pump priming, for those of you who aren't familiar with the term, is when the government ends up trying to put money in to a market in order to make it work more. So you can do it in a variety of ways. And basically what I'm talking about today is pump priming. So I'll run, because Ye-chan did excellent work, I'm just going to mention the Korea thing, and then I'll switch fully to Japan. So Toksuche is I think it's Kokubetsu site. Anyway, special bonds. That would be, that's just bonds that are issued by government agencies or quasi-governmental agencies. And these things have been around for a long time, and essentially they still are. So the bulk of social bonds remain Toksuche. And you can see the ones who are most involved in this as well. The profile, so this is the pump priming story, right? Is that the companies don't start in this at all. They're basically not players. It starts with the government. Only the government can create this. It turns out that the biggest purchaser of social bonds in Korea is also the government, the national pension system. Okay? These are actually extremely good bonds for a pension system to buy if you want something, because they're government guaranteed. So you can look good, it's government guaranteed. The point is, the 2 points. So I'll just finish the thought that I had, which is that you're starting to get more corporate issuance. So in other words, the government proves the possibility of the market. And also there are government purchasers. And then corporations have gotten involved as well because they see that there are benefits from this. I should probably say at this point, social bond, okay, so why would you issue a social bond? Or why would you buy a social bond? Why would you issue a social bond? I guess it's a bigger question. The reason for environmental bonds, for sustainable bonds, green bonds, is that they pay better for the issuer, right? Because you, as the investor, want to buy something, and you're going to buy a 10-year bond, and you want to pay that little extra something because you want to show how environmentally conscious you are. So you're willing to pay a little premium, which is often referred to as the greenium. And there's a similar notion in social bonds, where it's called the socium. I think you're going to see where this is going. I don't think there's something in governance bonds, but I guess that would be governium or something. But the socium is small, but exists. in the United States and Europe, non-existent in Japan. So this is largely a means of marketing, but it is not a means of getting, for the issuer paying potentially a lower interest rate. It is a means for, it's attractive, but that makes it kind of a little bit of a strange story, but let's just operate in here. So I think I've touched on this already, but let's put a few more facts on it. So we're talking about, when I say supply and demand, you can also think of it as mobilizer versus allocator. And that's the way that you move money through the system. In Japan, most of you who know Japan well will understand that this is postal savings and zaisei toyushi. And in Japan, the mechanism for mobilizing funds has been the postal savings, postal insurance, and the national pension system, which together are enormous. There was a point towards the end of the 1990s, while we were still having a banking crisis in Japan, when postal savings accounted for over 35% of all deposits in Japan, and postal life insurance accounted for over 40% of all life insurance in Japan, and Japan is the world's second largest life insurance market. So these are large amounts of money. And Korea also has a much later established national pension system, interestingly enough. The national pension system was initially designed way back in the 1960s, not introduced in the same way, for the express purpose not of helping you with your pension, but of accumulating enough funds to invest in Korea's economic development. It was very consciously a mobilizer, right? In a way that the postal savings was in Japan as well. And Korea has a smaller postal savings situation, and they also had a bunch of state-owned banks. So in government allocates, we're going to now drop Korea and focus on Japan. Until the year 2000, these funds, which are known in a legal sense as entrusted funds, because they don't belong to the government. Your postal savings, that's a deposit, that money belongs to you. Your pension, you put your money in, that belongs to you. These are all considered entrusted funds that the government has to manage in a way that's responsible. Responsible is defined by law, and it changes over time. But until 2000, it was directly budgeted within the Ministry of Finance in the Financial Bureau, which also issues bonds and redeems bonds and such. In 2000, as part of the many reforms that were going on in Japan, you got FILP reform as well. And formally, the relationship between postal savings, postal insurance, national pension, and the FILP agencies like Development Bank of Japan, the small and medium-sized enterprise, Kinko, what do you call it? Anyway, that thing, et cetera, right? And those are formally severed, but if you look at what happened is they continue to get exactly the same amounts of money. But technically, right, Postal Savings Bank is now, even before it became Postal Savings Bank, is doing the investment, right? They're self-responsible, as they call it. And then post 2007, you have the actual establishment of Postbank and Post Insurance. And there you have that continuing informal relationship is partially separate. But that raises the question of how do you generate funds for public interest corporations like Development Bank of Japan. Well, Development Bank of Japan isn't the problem because they're supposed to not lose money anyway. So they can issue their bonds, people will buy their bonds, they're fine. But other things like, JICA, the ODA agency, okay, well, they might be losing money. I don't know. There are other things that are there, that potentially might lose money for investors. And so, I'm sorry. And so there needs to be some mechanism to fill that. Okay. So if we look at the growth of Japan's social bond market and green bond, you can see green bonds have grown really considerably. Social bond market has also grown considerably. I don't think we need to go through those numbers. There are two things. One is to substantiate that I'm not lying to you, and the other is to give you a sense of the size. So this is a maxing out at $1 trillion yen in the would that be the second quarter of 2023, and here you're seeing 30 trillion yen. So the green market is much bigger. I'm not going to try to advertise to you that social bonds are in that range, but they operate in similar ways. And the green bond market in both Korea and Japan has also been constructed in some ways similarly in the cooperative relationships between quasi-governmental banks, other financial agencies, and government and financial actors. And I have a little bit of information on that, but not enough really to present, but we can do it in Q&A. Okay, so if we look again at the Japanese social bonds, and they have wonderful statistics on this, it's really completely overwhelmingly public sector. And there is some private sector, some foreign too, but there's not that much. And really our big story is the single biggest category is highway authorities. Philp agencies is a really broad category, and I'm just using the category from the spreadsheet that's publicly available. But what you see is, again, this public sector story. So our basic argument is that in a world in which Philp has been disconnected, in which the entrusted funds have been disconnected from these public uses that used to be under Philp, that social bonds are a way of partially reproducing that, while at the same time trying to build up a market that might be attractive to a variety of official and private investors. Okay, so and we see this goes. I did this whole thing of financialization, and it wasn't coming out of nowhere. One of the things we see is that the centralized allocation of funding declines a lot in the early 2000s, and it basically stays pretty low. Exception being obvious. Okay, so this is the Philp bond issuance is so that's a combination of ones that are issued by Philp agencies, but also by Philp itself now will issue bonds. So you can buy something that's just a Zaisei Toyushi bond, and then that will be allocated out to the different organizations. That would be done more to the companies that are not like DBJ, that are more likely to lose money. Okay, so let me just finish up quickly. One thing that's notable about this is this idea that developmentalist institutions and traditions can accelerate diffusion of financial innovation under some circumstances. And this is a fairly specific one in which even Europe, right, both on the supply side and the demand side, that the government is really important, both as direct participants, but also in terms of setting rules. The question is, does it ensure long-term success? Does pump priming, will pump priming of this sort of sort of trying to create a market, will that become attractive to private sector actors, or will it just remain a substitute for the Korean special bonds or Japanese Philp bonds forever? And this last one is just kind of a speculative question. There's no answer to it. So I will stop there. Thank you very much for listening.
so much. We'll now turn to the Q&A. As our usual practice, we'll ask one of our associates to ask the first question. And today, our asker will be Yo Fukuda, who's an associate at the U.S.-Japan program this year, but his job is at the Development Bank of Japan. This year, he's working on a project entitled The Future of Public Financial Institutions, Japan in Global Perspective. So please, Yo.
Thank you for your informative presentation. My name is Yosuda, and I'm originally from the Development Bank of Japan. And my question concerns how to developing the social bond market in Japan and South Korea. So to further expand these markets, I think that we need greater involvement of private capital. So in your view, what should these your developmental state financial systems do on both the demand and supply sides to effectively engage the private sector?
So I think one of the big questions is always like, where is the value that's gained from these things? And so, for private sector issuers, the benefit is that they're able to state that they're involved in corporate social responsibility. They're helping to, cure diseases. They're helping produce new housing, whatever it might be, new hospitals, and so that may or may not be mandated. So, like in Europe, it's mandated, or parts of this are mandated. And so therefore, there will be a market that will develop, whether it's a highly traded, highly liquid market, whether it will be, a well-priced market, whether it will be, attractive enough to companies to want to be, getting involved in like building dormitories for their workers, which as far as I can tell in Europe, but it's quite common in the Korean ones that I've seen. So at the moment, we're still seeing a proof of concept of what the demand is going to look like and whether that helps the companies. I would say that a few years ago, we could confidently come out and proclaim that ESG bonds are really popular and that there's clamoring for green bonds and for socially responsible investment. I live in the United States, so there's like a lot of noise around my head right now about these things, and so I feel like it's not. Like there are states in the United States that are basically saying we can't put our pension funds into something that claims it's socially responsible. So you're seeing this rapid adoption. But the real story is that pretty much anywhere there's got to be a cooperation between the investment side, issuer side, and government. And so in the case of the Japanese green bond market, for example, I know that there have been a number of quasi-governmental banks. Yours is one of them. JBIC, the Japan Bank for International Cooperation. They've been working with the FSA and at least one other government agency, I'm forgetting which one, and then also with like Tokyo Stock Exchange and some of the major investors. And they have like study groups and things like that. And those are the places where they're a little bit opaque to me, but those are the places where the decisions will be made that will make this type of financial instrument useful. I should say one other thing is that most financial innovation is going to be less driven by the potential of government than social bonds, because most financial innovation is things that are going to be issued by private actors and invested by private actors. So, and I'm not saying all financial innovation is good. I don't know how you guys feel about crypto. I'm not a fan myself, but crypto is clearly financial innovation, right? Various forms of digital finance, various forms of algorithmic trading, all these sorts of things are ones, though, where the government's role has been largely in in regulating and enabling rather than creating markets. And this is interesting because this is a place where government is literally creating markets. And so the big question is, do corporates care? And do investors care? And that's your job. My job is to try to explain what happened after.
Thanks so much. Yes, and if you could introduce yourself as you ask your
はい、
question.
小市中のAssociate at the US Japan Program. Thank you, Bill. I didn't know anything about this, so it's very interesting. But I'm also sort of wanting to ask you this question, whether it's a story of, I mean, how significant is this change in terms of, so how is it different if one of the main arguments is that the developmentalist institutions play a role in Japan, sort of, and I understand it's not so much sort of innovating itself, but rather taking what the Europeans started and then adapting it to Japan's and Korean's purposes, maybe. And so, c'est la même chose. That if it's public sector, and if it's not that big yet. And I was also quite curious to ask, what is it that what's the social aspect of the highway corporations want? I hope it's not building more highways.
That actually is an excellent question, and that would require my looking at the projects. I have a spreadsheet, and I can say when they were issued and in what amount, but I can't tell you what they were issued for.
Yeah, no, because well, being suspicious and also sort of knowing how tenacious these traditions and cultures can be, and the institutions too, that maybe they're just adapting using the latest sort of
So that's precisely the argument.
Yeah.
And so public purpose by governmental agencies or quasi-governmentals is defined by government. And so I'm sure I won't say what the highway funds are going into. I mean, it could be roadside amenities for all I know. But my guess is it's probably highways. And so this is it's a recreation of the developmentalist approach of mobilizing and allocating capital through relatively central purposes, with the center taken out. And that's maybe even more evident in the South Korean case. And we have better statistics so far that show that the national pension system is by far the largest investor in, say, green bonds in Korea, by far, not even close. And the biggest issuers are government agencies and quasi-governments. And the link has been formally cut, and the ability of the government to simply allocate fiscal resources has also been reduced. We all know Japan's got big debt and deficits, so they're quite constrained. Raising taxes is difficult, and so this is it's a way of not fully recreating the world, right? Because there's still markets in the middle. It changes the types of guarantees you have to give, the types of projects that are going to get attraction, but it allows for that recreation of the mobilizer allocator link, which helps explain why Korea and Japan are so far ahead of the United States, Germany, basically everybody but France. And on the French one, if you look at the French one, that huge number, I forget the percentage of it, but it is largely one big project that's gotten that's done a lot of issuance. So yeah, I think you're precisely right. Yeah, I hope this makes you happy.
Yeah.
I love to tell my French people hi that.
Thanks, Bill.
Susan?
Very fascinating, and something I really knew very little about. And, but it's a little murky to understand the motivations for creating and then on the demand side, who's buying. And you give one of your, on your list of Japanese issuers, you say national universities. So can you take us through that? National universities get their funds from where and then create this?
So that's a fantastic example, and I probably should have made the point of doing this. So as we all know, Japanese national universities got sort of partially privatized, or privatized in name, and so they become whatever it is, Dokuritsu Kyoiku Hojin, is that what they're called? Dokuritsu, yeah. And so, and then they end up responsible for their own budgets in a way that they kind of theoretically hadn't been before. And again, I'm not an expert on the way that Japanese universities work, and maybe someone can correct me. But that enables them to issue bonds directly instead of just getting allocations from the government, which is the way that they used to operate. So it's, tuition, direct allocations from government for tuition, research, and I have to go and get an allocation in the budget if I want a new building. Now, if I want to buy a new building, I do what Harvard does and I issue a bond, except that I don't have $60 billion endowment behind it. So the disconnection of the university from the government, from the budgeting system, creates a demand for financialization. And this is one of the forms that financialization can take. And so, that's our Meiji story or whatever, of privatization that's not, sort of ideologically driven in all cases, but is sort of financially driven.
And then on the demand side, who is buying those university issued bonds?
So we don't have good visibility into that, or I don't have good visibility into it yet, but it seems to be a combination of Japan Postal Bank, Japan Postal Insurance, National Pensions, GPIF, the government GPIF, what is this? Is the pension investment fund, largest pension investment fund in the world, by the way, and but also some private actors, because essentially these are they're government guaranteed at some level. To me, so somebody can correct me on this, but they're fairly attractive in that respect. But there's more self-responsibility on the university side. So it puts more pressure on the universities to behave in certain ways, but it also reconnects those old funding streams in a way that isn't obvious from the fact that they're issuing bonds and calling them social bonds. And some of their bonds are not social bonds.
And the social good that's getting created is like the new building on the campus. Okay.
Yes, and introduce yourself, please.
Yeah, I'm Daniel Roberts. I'm a PhD candidate here in the Department of Government. Thanks for presenting on this. It's really interesting. I am kind of curious about how to think about the US case in ways that would inform Japan. It was interesting to hear, for example, like France, there's applied to housing. I saw JASO in like the list of like Japanese issuers, right? And if you look at the US bond market, there are huge entities like Fannie Mae and Freddie Mac in housing, Sallie Mae in education, and various other sort of like quasi-public authorities. Speaking of universities, for example, like the University of California is a big issuer of bonds for building dorms. And so I wonder like whether this coding here of social bonds kind of accommodates the type of activity that the US is doing, because my intuition is that it might be a lot larger than France.
No, it's much larger. And every country, you could identify things and call them social bonds. It's just that to be a social bond, you have to say, I'm issuing a social bond. It fits the it fits this definition, and then there's 4 ways that you have to demonstrate that it actually is a social bond, right? So there's millions of these things. In the US, the main way that we manage that, by the way, is by making them tax-free. So like municipal bonds or Turnpike Authority bonds or something like that. If you can, that makes them more attractive for people who have, higher tax brackets than I do.
Yeah, and I guess my quick follow on that, if it's sort of like a labeling thing to call it social bonds, might that suggest either maybe the US does have more of like a developmentalist legacy, or maybe there actually may be more direct borrowing of like Japan and Korea on these sort of American models?
Yeah, so I don't want to say developmentalist, because I think if you look at the American model, that all those turnpike authorities and things, those are going to markets. So they'll go to they're primarily going to be institutional investors, but they are going to markets. They're not being purchased by government in any way, shape, or form. Right? Like, they're not being purchased by our social security system. We don't have postal savings, et cetera, et cetera. So that the institutional framework helps to create the possibility and I would say rapid conversion, if you wanted to, in the US, if people actually wanted social bonds, right? We could convert. We could have a burgeoning of these things quite quickly. The Japanese institutional framework is quite different, and it operates in a way that may be a little bit surprising, because that you or I would, if I were to tell you, oh, we have this thing called municipal bond market, and turnpike authorities can issue bonds and stuff like that, and there's this thing called social bonds, you would, without knowing anything about it, you could imagine the transition of this thing with using a tenth of your brain power, right? And that's a normal story, right? You have functioning financial markets that do X, you add on a little something, and you get Y. So U.S. had big bond markets. Somebody came up with the brilliant idea of backing them with revenue streams from specific assets. Was this 1980s? You get the creation of the asset-backed security market. Jack's your uncle, you're done, right? And it doesn't mean that there's not work involved, but the pathway is really similar. In the Korean case, Korea ended up with the second biggest asset-backed security market in East Asia. Well, not that surprising, because not that many places have big markets. And by a proportion of GDP, the largest, because of the Asian financial crisis. So suddenly the state takes over all these bad assets, and then they have to do something with it. And so they create the asset-backed security market. In that case, a lot of it's getting bought by foreigners, as I understand it. And so they're making that market through a mechanism that is that's really driven by the supply. So I think that each of these is a slightly different story, but that there's something there that these developmentalist institutions that are normally a hindrance, in certain cases, can be really important in developing the markets more quickly. And I could, if we wanted to, we could go further back into history and talk about, how the JGB market developed in the 1970s, 80s, et cetera, et cetera. But that basic story of the institutional setup kind of dictating what's possible, and I, sort of, not hypothetically, but to date, it hasn't been beneficial in financial innovation in other respects in Japan and Korea. But in these kind of limited spaces, we can see that the government ownership and that role as mobilizer and allocator is quickly adaptable into something that looks like financial innovation, if we think of financial innovation in a process.
You have a question in Zoom. The questioner has been waiting for a while, so this may be our last question. I know there were other questions, but my apologies. But Mary Alice Haddad, a friend of the program and a friend of us all, has a question. Hi, Bill. In my research on green bonds, a significant reason for the growth was that green projects were less risky than other projects, e.g. toxic spill, worker strike less likely, which equaled lower costs of capital, thereby moving them from the CRS/PR section of the company to the C-suite. Is the same thing happening in the social bond space? Is this just a lagged effect, or are the risk-lowering financial benefits lower?
So Mary Alice, thank you. I did not know you were studying green bonds. We need to communicate. But no, I think that the the green bond space is much more driven by private sector issuance, private sector investors. So there's a lot of public sector, and now I'm speaking out of book because I don't have the stats in front of me, but there has been more movement in green bonds, and there are a lot of business opportunities in green bonds that aren't necessarily obvious in social bonds. I mean, you could potentially make money on social bonds. Like there's the drug company's name I'm blanking on that said we're going to develop, some drug, and so you can see some profitability out of that if it were set up as an impact bond. But I mean, basically, for investors, I don't think it makes a huge difference. Depending on so then we need to categorize. So most social bonds are just issued by the entity and are considered what you would call general obligation bonds. So whatever it is, so the rating would be on the entity. There are also something called the social impact bond, where it's based on the project. Right? So in the case of the social impact, and the same is true for green bonds and sustainability bonds. So if you're talking about a company, honestly, it makes no difference to me as to whether I think that Toyota is going to lose money. I don't think Toyota is going to lose money, but I think that Toyota is going to be able to pay back a social bond as well as it can pay back a green bond as well as it can pay back a general obligation bond. It makes very little difference. It may just be that I want to have the social bond in my portfolio, the green bond in my portfolio. If it's an impact bond, if it's a project-based bond, then I think your story is much better. And I'd be curious to see how that operates in the green bond world.
Thanks so much. Again, I know there were other questions, but we've reached time, so I'll have to close the discussion. But please, everyone, join me in thanking Professor Grimes for